Okay, so the panel today will be discussing role of big data in investing. Maybe we start with sort of panelists introducing themselves first, and very briefly kind of explaining what is their role kind of in the whole big data ecosystem.
My name is Matthew Rothman. I work at Credit Suisse, where I run quantitative equity strategies, where we're looking at all sorts of alternative data sets, internal, external, that can be useful for predicting the cross-section of stock returns as well as industries and countries.
My name is Peter Hafez. I'm the Chief Data Scientist at RavenPack. We do a lot of internal research on our own data in order to guide the market on how you can take advantage of RavenPack data within their investment process. We have been part of the alternative data space right from the beginning, even before that term also existed. RavenPack has been around for about 13 years, so we have kind of seen how everything started and how it has developed over time. And it's been a quite interesting journey.
Hi, my name is Yin Luo. I'm Vice Chairman and leading the quant and macro research efforts at Wolfe Research, which is a boutique broker-dealer in New York City. My team and I basically use, again, the same buzzword today, big data machine learning for probably over 15 years in both global equity, but also across asset classes. So this is very similar role as Marko and Matthew. So we do sell-side research. We look at signals, can predict stock returns, asset returns, and risk, and portfolio constructions, and kind of things. We're actually one of the first users of RavenPack back in 2008, almost 10 years ago.
And I guess in the context of this panel, I should mention my role driving research at a firm called Manifold Partners, which is one of our portfolio firms. And in that role, I fund independent research teams to develop particular AI techniques utilizing big data on a common, robust platform for virtually unlimited information. And the thesis is that by separating the scientific techniques, we get better signal definition, and then we ensemble the techniques for use in the portfolios.
Well, thanks. Let's start with sort of talking basically how are our clients using big data in their investment process. So I think it's a question which is sort of relevant for everyone. There may be different angles, sort of fundamental investors, quant investors. In the case of a RavenPack, would be all kind of end users. So let's, maybe each of you sort of give some examples of sort of who are your clients, how they use it, what are some of the specifics of their usage. Maybe we can start sort of in order. So Matthew, if you want.
Thank you, I guess, for letting me begin. I think that there are. It's very bifurcated. We have some clients who are really, I would call, early adapters and have moved very far along the path of using big data. You can probably guess a number of those types of hedge funds and firms that they are, and I would say that they have done a lot of very sophisticated things. From all sorts of types of data, from news to text of all sorts, to satellite imagery, to really credit card information, web scraping. They're very, very, very advanced. I think we have another set of clients who are playing with these types of things and beginning to they're trying to play catch up. And then I think our fundamental clients are really becoming very interested. And I would say that there's almost beginning to be, among our fundamental and kind of what some of those less early adapters, I think there's almost a mania that's taken hold, where people are trying desperately to figure out how far behind are they? How do they catch up? What does this mean? How do they begin to use it? What are the techniques? What are the data storage techniques? And so we're doing a lot of hand-holding, trying to help them understand this whole world at this point, and I think that fits the majority of our client base, and the people who are the very early adapters are a small number. You could count them probably on two hands.
Peter, sort of for the RavenPack, how would you sort of break down the user base or end user base? Can you talk a little bit about that?
I can see generally I echo what Matthew is saying. We have, can you say, a user base which you would call the most sophisticated quantitative hedge funds and asset managers in the marketplace, and they have probably been looking at this type of data for the last 10 years. And of course, it has kind of expanded from these a couple of handful of firms and asset managers into a broader set of users, and more into more traditional asset management, still quant firms, and I would say more recently it has also gone into more fundamental discretionary type of uses. We have also seen a push into more compliance-related type of use cases over the last few years, more on the macro side, picking up on this type of data sets as compared to equities more early days as well. And those are probably covering most of the clients that we are speaking to today.
Ian, and before on the call you mentioned that you see quite a different use from sort of quants and fundamentals. You want to talk about that a little bit?
Sure, and I think this is, I also see my client being falling into two extremes, very binary. So on the one side, actually we used to deal with probably 70% of quants, 30% you call fundamental discretionary. Now the split is probably 70-30, but the other way around. And it's actually quite shocking. Most people, when they say, well, who are the users of big data, the natural choice, of course, is other quants. Actually, from what we see, is probably more of the opposite, right? So the fundamental discretionary guys seems to be, in terms of data acquisition, at least, far ahead of quants. So if you think about the consumer teams, almost every single consumer discretionary firms we talk to have some sort of credit cards and satellite images and social media and some sort of data. Well, not to say they have the data and they know what to do with them, right? So that's a very different. So we do see almost every fundamental accounts. If you're energy, you have to have some unique data on the productions and inventories. And if you're consumer team, you have to have some sort of these consumer spending data. And they are quite expensive, right? So they all have it, and they may not know what is the best way, optimal way to use them, but they are quite aggressive in terms of spending and the acquisition. Maybe part of that is survival, part of that is about peer pressure. If the guys across the street have the credit card data, we have to have it. And I think the biggest upside is really educate them what is the optimal way of using the data and translating from information really into insights and investment insights, right? So most of the time, it just let the analyst build some sort of one-time Excel spreadsheet, and it's highly inefficient. Most of them don't really do backcasting. Some of the very well-established firms, they do have a massive data team, which are really bridging the gap from the vendor data into investment decisions. But I would say many of them, they don't. Right? So that's one side. The other side is really all the quants. Right? So very surprising, I would say, most quant firms, they've been testing and arguing and then making screaming about we have to look at the alternative data, big data. But actually, most of them still happy with the traditional value momentum, not to say the term where you don't like. But yeah, so still happy with the value momentum. Maybe adding testing one or two, but I'd say 95% of the signals and the vast majority of the process still very much traditional company fundamentals. And I think part of the reason is for quants, one, the hurdle tend to be far higher. Right? So one, if you say, here's the data, very cool, but only have 5 years of history, nah. If the coverage is only 100 stocks, 200 stocks, I think generally speaking, we're seeing very little interest. If the correlation is about 70%, definitely no interest. Right? So it's very hard to come by with really true alternative data coverage with tens of years of history. Well, RavenPack, one exception. Very strong coverage and very orthogonal alpha. Once you have all of them, and again, I think there are not that many. So most of them are still happy with the traditional process. Right? So these are the firms with the resources, with the technology, and know what to do with the data, but generally speaking, tend to be very much late in the game in terms of data acquisition.
I have to disagree with you just a little bit, Ian. I'm sorry. I mean, I think that you have to just separate out what types of quant firms you're talking about, right? I mean, I think that if you're talking about the traditional long-only, Boston type of firms, You know,
I wouldn't be that specific.
right? So you know, like, you know, that are much slower moving, or some of those, right? I mean, I think you're absolutely right. You know, that they're going to have long debates about, you know, everything, and it's going to be very hard. But I think there are a set of hedge funds that are much earlier adapters, and are a little bit more nimble, perhaps.
And that's why I say 90%, 10%. The 10% are very smart firms. And I wouldn't be that specific about New York versus Boston. Actually, it's more about global splits.
So Ian, actually, I'll ask you this 70-30 for quants that actually evolved into 30-70 sort of for fundamentals. What do you think is driving that? Do you think that sort of, you know, there are two possibilities, right? Quants could have tested and they couldn't find the signal, or they sort of are now doing it in-house entirely, and then the other guys are learning about it, and maybe sort of a few years they'll do it in-house as well. What do you think led that sort of shift from 70-30 to 30-70?
Well, I think part of that is because quants have been doing relatively much better than the fundamental firms, right? So the quant is still exactly the same, actually still growing, but at a much slower pace than the fundamental firms who do need help, right? So what I said is just, if you already spend $10 million in buying all kind of data, it's probably worth to spend $250,000 just to get some help, hire some data scientists and use the sell side and trying to find a consulting firm who can better educate you to spending the little money to really use the data, right? So I think we're seeing tremendous growth from the fundamental side. Not saying the quant is being shrinking, quant actually is still growing, but I think they have the internal resources. They've been doing this for a much longer time. It's really the strengths or the growth from the fundamental side that's shifting this equation.
Actually, I would offer a slightly different taxonomy or classification, which I think simplifies this just a touch. First of all, it's essential to recognize, vis-a-vis the Boston firms, that quantitative firms are no less victims of their own orthodoxy than are fundamental firms. If you go into a fundamental value firm and you suggest that we should really buy story stocks, FANG, you know, et cetera, you will be rolled out of town on a rail. And the same is true if you go into GMO and suggest that they should take a look at market statistics instead of fundamental value metrics. You know, the orthodoxies that govern firms and constrain their evolution are very, very visible. The most important distinction, I think, you can look at firms that are trapped in their orthodoxies and reluctantly accepting the new, and I think that's still the bulk. And then if you look at the firms that are the early adopters, and I think that's exactly the right group to look at, people that are actually interested in change, I think you do find three different subgroups within that group that's interested in change. One is quants that are skeptical and are looking for something new, and those are typically going to be pretty secretive. They might even be they're often hedge funds that really care more about whether something works than whether it, quote, makes sense. They want to prove that it works. They don't care about whether it would have worked in 2007. They never plan to live 2007 again. I think the second group you find is people that are really interested in big data, not so much because it's big, but because it's more available. And this is a legitimate evolution for a fundamentalist, is to get more information as more information is available and feed it into the research process that is, you know, from the last century. So it's a question of trying to move into the current century. And the third group, which I think is a group that is probably growing more and more, are people that are actually studying data as data. In other words, they're actual data scientists. They're actual AI people. They are not building hypotheses of causality and trying to model those. They're actually trying to learn from the data and combine the data, build ensembles, and so on. And that's a very small group, and they increasingly are also a very secretive group. They are doing great stuff, really interesting stuff, not high frequency, but high association of the data. They're trying to find the Bayesian utopian and dystopian regions. And those groups are often driven with academics. They're often driven with people who believe in unsupervised learning instead of supervised learning. They're a very, very interesting group. The problem is, and you said this earlier, the people that have the money to actually buy lots of data are the dinosaurs. You really want to look at a high profit margin, look at a fundamental firm, you know, $40 billion, 11 partners, and $100 million in revenue, and that's a company that can afford anything it wants. Usually, it's just for the optics and for the appearance of evolution, but that is a conundrum. The best scientists are often not in the best financed companies, and the most aggressive are often the more secretive.
Okay, thanks. So that much on sort of user base and who's using. Let's actually turn more specific. Let's talk some specific data set. And I had a call with Matthew and Yin, and basically we discussed sort of okay, let's think of one data source that makes you sort of excited, that you believe in, and maybe one that you sort of got disappointed, or you think it's a sort of a blind, dead end. So maybe each of you sort of can give me some experience if your, history of research of big data and AI, where you sort of found something that you thought was really good and maybe still is very good, and one example maybe not so good.
You can go first this time, yeah.
So you want to go the other way around?
Yeah. Sure, we can go the other way around. So we think all four of our portfolio companies that work in this area, generally speaking, are highly skeptical about not about sentiment data in the RavenPack sense, but about Twitter data per se. The relevance of crowd thinking is not that interesting. We're interested in transactions, events that occur that have an economic cost or a social cost where we can relate a news item. We think the huge value of RavenPack is in the taxonomy and the architecture of relating things as opposed to the actual data source. Now, one thing that we've been generally disappointed with real-time locational data and froth data. One thing that we've found that is really bizarre, though, is we've actually found a number of data sources like IBES that are terrible at predicting active investors, real investors, but boy, are they good at predicting very large cap investors who invest through a committee, what I'll call the manatees of the system, okay? And if you think about it, a huge amount of money is invested with bank committees that meet, after the earnings report, and they move the positions just a smidge or a touch. Well, it turns out there's a fair amount of data that can be used to predict the behavior, the herd behavior of these large, underfunded, old-fashioned products. And so in a weird way, we've found some fundamental IBES-like data that is really useful in predicting the herd behavior of old-fashioned investors.
Yin, on your end?
All right, I think one of the most frustrating, maybe disappointing area that we're seeing a little too crowded and very hard to find a good product is probably around sentiment, right? Mm-hmm. So I echo Don's point is there are way too many vendors providing some sort of Twitters and web and blogs and type of sentiments. The efficacy tend to be fairly poor. The horizon is very short, and the history is very. I just said we don't care as much as about history, but again, the life history is very short. It's very obvious of overfitting in producing the signals. But having said that, I also think the most promising areas of big data, in our opinion, is also in related text mining, right? So this is, I think, one is a reason we use RavenPack, but also we do a lot of our own work. Is really the vast majority of information is still in writing, textual, rather than data, right? So we have far bigger information set in writing, in textual format. It's actually far from being analyzed, right? So in the macro space, which is sort of one area that I've been paying more attention to in the past couple of months, is the sentiment is somewhat overhyped, and there's so many different kind of sentiment analysis, all more or less based on very similar kind of data dictionaries. Not really well defined for finance. It's really not defined per industry. We all know the sentiment for biopharma companies is entirely different from the ones for banking, right? So they're really not fine-tuned for the specific context, right? So same thing for central bank announcements, right? So what is a dovish and hawkish statements? And really, what is really bullish and bearish? It really varies, depends on the economic cycle, depends on asset classes, depends on the countries. Depends on the specific context, right? So I think there's still a lot we can do, but we're not even close to where we want it to be yet.
And sort of your favorite one, like the one that you think is the most promising?
Well, this is one in work in progress. So one work in progress, again, just given my recent personal research interest more on the macro front. This is a company called Dodge, really collecting construction level data, both at the company level, but also at the municipal, state, and country level. We think has very interesting implications for both, I think, stock selection, but also for global macro, understanding the US construction, which is, of course, obviously a leading indicator. This is more like a real time, so we can build some sort of a real-time daily construction data, which sort of consistent with our research interest on nowcasting. I think this is quite promising. The data, again, is available. They have exclusive contract via Quando, so we source the data from Quando.
I'll take just actually a little bit maybe the other side of sort of the view on sentiment. You know, we tested, and this morning my colleague Rajesh talked a little bit, a number of sort of sentiment data. We do find them useful in specific situations. You know, so sort of long-short strategy, if you're basically your short leg contains something that is maybe have overly negative sentiment, but sentiment may be changing, you know. So sort of to maybe identify some sort of turning point where you can use perhaps sentiment in some conjunction with short interest data and stuff like that. So in some very specific uses, we actually did find quite interesting value add from sentiment on, let's say, stock level. You know, other example is it was covered in our report from May, where we basically look at that. I mean, you guys are sort of, you know, don't like a Twitter, but there's a firm which is sort of analyzing Twitter and for individual companies, you know, and then from individual companies they aggregated to the index level on, you know, to S&P 500 level and provided daily, you know, and there's about 3-4 years worth of history of that, and we tested it for short-term trading of S&P, and actually it makes money. Now, a little bit of caveat, there is an overlap with momentum, you know, like, so sort of sentiment, people get hyped up on stocks, talk a lot of good stuff from, can you guys hear me? So basically this aggregation of Twitter sentiment sort of from the, from the stock level to index level and trading it sort of daily, we find it works, produces a relatively reasonable Sharpe ratio. We did find overlap with momentum, so that's sort of when my mic went off. So basically it does pick up some broad market sentiment, but correlation is not, you know, it's I think it was around 60% maybe or something like that. So if you make it as an overlay to momentum strategy, it still actually adds a value. So I know there's sort of a lot of firms providing sentiment. I think probably there are a lot of sentiment signals out there that don't work, but I would say, you know, I wouldn't say it's like my top signal, but I wouldn't also say it's my sort of the least interesting. So sort of anyway, I'm just as a sort of moderator, you know, providing a different angle. All right, so let's
don't skip over me on this one.
No, I'm not. That was your sort of favorite topic. Actually, I'll go to Peter first, and then
no problem.
And I'll check the mic.
Just to continue on the Twitter discussion, I think, you know, Twitter is a little interesting. We have, of course, also done some analysis around it, and there's no doubt Twitter is hard, and a lot of the products that are out there kind of take more of a whitelist approach instead of going after the full fire hose, because you also have these type of things about, you know, why are people saying what they're saying? Do they have, you know, can we trust what is being said? So from an event-driven perspective, you definitely have to take a whitelist approach in trading. So you go for the Twitter handle of the firm. You go for particular influencers. It could be journalists or something like that. Otherwise, you have to go more from the wisdom of the crowd, take that type of attack on it. Of course, there's also a lot of news that is being shared via Twitter, and generally, if you start to control for what you could have captured from more traditional news wires, which will give you a cleaner signal, a lot of the value starts to go away when you look at Twitter. Yeah. So, and why not go for more of the clean source rather than trying to get it from Twitter? Of course, you can start to look at something like dissemination effects, which could be an added value on top of what you might get from the news wires. So I think you can probably find some quite interesting use cases, but it's not where the alpha is most easily achieved. And I think I always, when I look at all these news stories talking about how Twitter broke some event first, I actually kind of cringe a little bit because they completely ignore false positives here.
I would agree on that one. I was thinking along the lines of basically how certain story may become viral, right? And eventually sort of become self-fulfilling, so you can have a sort of article, nobody picks it up, people ignore it, or something sort of propagates through internet, Facebook, Twitter, so on and so forth, and eventually does trigger some people who are investing to say, hey, look, I like the stocks, like a lot of positives. News hits eventually decision maker, and maybe retail investor could be like a PM that on margin it sways him. A lot of people still kind of have this behavioral bias towards, kind of jumping on good news and on hypes. But anyhow, very valuable perspective. Any data source that you, or type of a data that you particularly feel excited about?
Of course, I'm a little biased here. I really love the RavenPack data, but I think what's interesting is more perhaps how some of the technology is changing and how some of the data sets that we're seeing and that may have been popular or have been hyped in the past might go into another lifespan. And I think as we develop as an industry more advanced knowledge graphs, being able to connect more entities in a more clever way, tracking products and services and all of these type of things and linking it to companies. I think actually a source like Twitter could get a second life, because from my perspective, Twitter is really mostly about trying to get the wisdom of the crowd instead of wisdom of individuals. But if you want to extract value from Twitter, which is unique, I think it's more about consumer sentiment than it is about people talking about companies. And if you want to do that, and get the consumer sentiment, you need to track the products and the brand names, because I might talk about I love the new Q5. But I won't necessarily say that it's from Audi, and I'll definitely not going to say that it is from Audi, owned by Volkswagen. So you kind of know what security you need to trade. So you need to have pretty sophisticated mappings between all of these various entities. And I think when we get there, it's a very hard problem, as you can imagine, with the number of products and services available out there. When we get to solve that better as an industry, I think these type of data sources will become very interesting again.
Thank you. So Matthew, your favorite question?
Sure. No, I'm glad to agree with Yin. I think some of the macro data sets out there are really interesting. He mentioned the construction one, which I think is really interesting as well. That's available on Quandl. I think another one that isn't, I don't believe it's available on Quandl, but it is available, I think, by market, that I really love is called Peers. And there's also other providers of it, Panjiva or Import Genius. I like the Peers data set the best, personally. And what they actually do is have every bill of lading for every ship or rail car entering the United States. And so they have the actual, who is the actual sender of the information, what is in the container, how full is the container, and who is what is in it, and where is it going to, the company, right? And you can begin to imagine all sorts of uses that you would want this for, right? I mean, besides just how many Ivanka Trump shoes are going to Nordstrom's, they can tell you that in real time, day T+1, they give you this level of information. And you can do it for stock selection, you could do it for industry rotation, you could do it for macroeconomic signals. There's all sorts of things that you can do it. Peers has the data going back into the mid-18th century. They were going out in those days and rowing out to the boats and getting the bills of lading, and then they have digitalized that information and have it. And so it's really quite remarkable information that is out there, and so you can test it. Of course, they haven't done a lot of the harder work about getting all the QSIPs right and mapping everything and doing all of that, and so there's still a lot of very hard work to do around those data sets. But to me, it's fundamental. It's real. I can touch it. I know. I can explain it both to a quant as well as to a fundamental manager about why this type of data is important, and so that gets me excited. What I found most disappointing, is I guess, I was so excited by so much of the Google text search data. I loved Hal Varian's paper when it came out that said that, wow, he could predict unemployment with looking at Google searches. And so actually just the other day, I went back and tried to replicate Hal's work on this. And so I went to Fred, which is the database from the St. Louis Fed, and got point-in-time, unrevised, unemployment data. So this is actually what we knew at that moment in time, doing it correctly. And I lagged it 1 month, and then went and looked at the Google search data that did it, and I paid no attention to what the actual searches were. And you can get an R² for predicting unemployment data that's somewhere in the high 90s. I mean, like, it's ridiculous, like 98% R² actual out of sample, or I guess these are in sample, but predictions of unemployment. And then, if you go actually look what are the search terms that people are looking for, there's some nice ones. The third most popular one happens to be unemployment appeals, right? So, that makes confident. Like, I could go into your office and tell you, oh, that would be useful, right? And the fifth most, and by the way, that's a univariate one that has 97% correlation. The fifth one is, unemployment, submit your unemployment claim. That's pretty nice also. The first most popular item that correlates the most with unemployment is black celebrity kids. Right? I mean, explain that to me. Like, do you feel comfortable? Like, the second one is Failblog. Like, I don't know how many people actually go to Failblog, but that's like America's Home Funniest Videos, right? Where you look at people who are jumping off things and smashing their heads. Like, that does it. The seventh most popular one is Jailbait Teen. Pornography. I don't really quite understand this. The 10th most popular one with a 96.6 correlation is Amazing Superpowers. Right? I guess that would be helpful to get a job if you had amazing superpowers. 38th, again, with a 95.6% correlation, individuals' clumps of mascara. Right? So, I don't know. What is endogenous? Maybe you're losing your job because you're spending all your time looking at Failblog, and that's useful. I don't know. I guess the other one is that's very useful is I'm sorry for compliance that I can never actually do this in a research report is home sex tape. Maybe again you're spending your time making home sex tapes, or maybe it's because you actually are losing your job. Now you're making home sex tapes to actually make money. I don't know which way the causality on any of this goes, but it's a little bit harder if I was going to walk into your office and try and sell you my macroeconomic model. Multi-factor on any of these, and you were to start questioning me on like this. And by the way, it's not just unemployment. You can go do the same thing on the housing price index, and you'll see the number 7 or number 6 most important things is millimeters to inches, right? Why that is so important to predict, housing price indexes, I'm not quite sure. But so I guess I'm a little disappointed that Google search engines really don't work all that well.
All right, that's interesting. Yeah. A lot of these things, obviously, causation, correlation,
spurious correlation. Exactly. Of course.
All right. So actually, on that note, let's talk a little bit about sort of challenges and pitfalls of using big data and AI in general. And this can include anything from sort of challenges in legal terms when it comes to non-material information or personal identifiable information, so some sort of privacy concerns. More broadly, sort of the whole issue of sort of, and we are actually getting short on time, issue of, how much is this of a fad versus how much is a true revolution? How much you think some of the firms use this as a marketing to kind of show that they are at the forefront of technological developments versus how much really risk is put into these type of strategies, So any kind of thoughts on pitfalls, challenges, and kind of visions of the future. So you can pick any of those that you feel strongly or feel you want to share your insights. And again, I think order. I don't know who wants to start first.
I'll start.
Don.
So I guess first observation, I don't think there's any way, shape, or form that a technological revolution is a fad. That's not to say that there's never a retrenchment or a repurposing of it. But 9/11 put CNN on the map only in the context of the Vietnam War putting NBC on the map. And I am told in 1959 was the first time a weatherman went out and actually stood in the weather, which has now become an absolute mandatory requirement that you stand out in the rain or the flooding or whatever to illustrate what it feels like for the audience. So I don't think this retrenches in any way, shape, or form. That being said, I think that three things are worth focusing on in terms of how it's going to develop and what the pitfalls are. And one of the pitfalls was just illustrated brilliantly, and that is the pitfall of presumed causality, which is a human thing. We tend to want to assume that things that are temporally adjacent are causal and so on. And so I think that hypes the utility in a really dangerous way. The other thing that I think is dangerous or has to be really watched out for is the interesting problem rather than the actual problem. One of the reasons our researchers tend to focus on actual things, transactions, is that, for example, if we wanted to predict iPhone sales, we think within a few years we're going to actually have ticket level information on credit card purchases combined with the bill of lading information. These are real economic transactions traced through a system where they're with very high reliability, and we don't particularly want to gather that information in a frothy way when we can just wait and gather it in a real way. The third thing I would say, and this really ties into something I said a little bit earlier, and that is that if something is really a revolutionary improvement or an improvement in utility, it very quickly goes from something that gets talked about to something that doesn't. The electric typewriter was a really, really big deal, and then it became an absolutely universal phenomenon. And it's not that it didn't get a lot of attention. It did, actually, in the job sense that we saw in the presentation. Lots and lots of people hired to use them and build them, and then off into the PC universe and so on. But it soon becomes a universal component. And I think if you're trying to use, if you're asking the question about big data, it's going to be ubiquitous. If you're asking the question about portfolio management, actually, I think there's a real question as to how much sharing in an alpha scarce universe, how much sharing is intelligent, how much sharing should there be, and one of the byproducts of that is that we're going to end up with very, very ubiquitous data, but we're also going to end up in highly partitioned use of that data, partitioned and encrypted, and separated not just between the vendor. And the fact that a RavenPack person can talk about how people are using the technology, 5 years from now, that'll be a violation of the terms of use. Because the users are going to want to know that their world is controlled. That is an example of something retracing back to 5 or 10 years ago when people had their own systems, they didn't use the cloud, et cetera. So this isolation into pockets of utility is going to keep right on going, and it's going to make the ecosystem much more complex and interesting, I think.
Okay, who's on next? Matthew, you want to talk about pitfalls, risks, hypes?
Sure. I mean, I think one of the things that, as a pitfall, that is going to be challenging is no one's really mentioned regulation. And I think that we're going to face regulation both from the privacy end and that there is going to be coming pushback from people on this, that there is going to be that what we're doing today and on all these kind of credit card swipe data, on all of these kind of things, on where people are going to let this happen on the Equifax things, that there is going to start to be some level of pushback on the types of data and the way we use it. And I don't think this goes on unfettered forever. And I don't think that anyone has really talked all that much about, we talk about big data on the privacy end, it gets a conversation, but there really hasn't been much on the capital markets end and what is appropriate and what isn't appropriate. I think we all know in this room, or should know in this room, that you can dynamically scrape a website in real time and figure out what hotel reservations are for pick your chain, right? And you can set up an instance that would do that in AWS, and by tomorrow afternoon, if you're any good, or even if you're not very good, you can just go to like a commercial vendor, right, that you can find on the web in 10 seconds, and you can set it up and do it in AWS, and it'll scrape the website for you of this hotel chain in under 30 minutes, and you can know their revenues for the next year out. Now, is that material non-public information? I don't know. The lawyers aren't really going to tell you at this point because they don't know. You've probably violated the terms of use. Are the terms of use actually legal doctrine? No one knows. There's no case law. You've violated probably the robots.txt. Is that legally enforceable? I don't know. And anyone who tells you they do know is lying because there's been no case law on this. But there's going to be at some point. And so how this all plays out, to me, is just kind of the big unknown.
Yeah.
All right, I'll take next. I think it's just a related question. So I wouldn't talk so much about pitfalls. I think talk about the challenges. I think the biggest challenge we're seeing is really on the talent side. Right, so we're going to find the data scientists, which I don't think they even exist. Right, so trying to hire someone into finance, I think, is extremely challenging. Not to say about that, no way too many MFE type of grads, and everybody had the resume about deep learning, NLP. But if you actually ask them, like, well, actually, how do you actually do the NLP and deep learning? Well, I use the R and Python packages. It'd be surprising. One of the very simple interview questions we ask them is just, how do you actually invert a matrix? Almost nobody can write an actual algorithm to invert a matrix, especially if you give them the matrix. One column is in the millions, the other one is in the 0.1, and nobody knows. Actually, you just need to normalize computer z-score. You do the matrix inverse. Actually, almost no candidates can even write a program to do matrix inverse, right? So I think it's just developing from the first principle rather than just borrowing a sort of off-the-shelf algorithm is very difficult. We always have a hard time to find the actual machine learning experts, not to mention about the domain experts. When I was at Deutsche, one of the domain we're trying to hire was a PhD in accounting from one of the top programs. We tried it for 4 years with no success, right? So 99%, well, first of all, there are only about 10, 15 PhD programs in accounting doing empirical work that we want to hire. Each one of them has 2 or 3 students per year. 90% of them want to work in academia. Among the very few probably getting hired by Google or to the buy side. And so very few of them want to work on the sell side. So the chance of finding them is essentially 0, right? So these are the sort of problems that we're facing over the years. We have clients asking the question is, how about to find a data scientist? And specifically, bracket, we don't want to hire a quant. Right, so, but we're going to find a data scientist, right? So we cannot find any, right? So they end up 99% of the time you're hiring a quant. Then they'll tell the quants, we don't want to affect the model. We are fundamental shop. We want to help our fundamental analysts and PMs making decisions. So don't build a value momentum affecting model. But guess what? 99.9% of the time, the first thing they build is another affecting model. Right? So because that's what they have done over the years. Yep. Right? So this is sort of the challenges we're seeing. The other big challenge we're seeing is really psychologically, well, how do you actually convince the founders and the senior managers to use machine learning, right? So as we all know, most of these very senior people came from finance background or econ background. We all trained, as myself, we grew up in the Barra's multi-factor model. Again, Barra Rosenberg and Barra model, we train, everything is linear, at least linear is a good proxy of reality. You're trying to convince them that machine learning, the nonlinear models, may give you something different. Again, the common question is, well, yes, if it works well, great. If it doesn't work, how are we going to explain it to our clients? But guess what? When we meet with asset owners, right, so the sovereign fund, the pension funds, the fund of funds, the first question they ask is, tell us a manager who actually manage money using machine learning, not only just like doing R&D, doing some sort of things. I would say, do you actually care about transparency? Actually, no, just tell us a reputable manager who actually manage money using machine learning, we have a hard time to find, right? So we're not saying there is none, but there are not that many. And the ones that actually do use are probably already reaching the capacity, so they don't take new money anymore, right? So I think the talents and the psychological reasons are probably two of the biggest hurdles, at least from what we've seen.
I just want to emphasize that that completely endorse that perspective on the traditional managers in particular. We get often asked by traditional firms to help them hire someone who can do data science and machine learning. And it turns out that what they really mean is they want someone to come in and talk that language in front of clients, but actually not do anything. That is a really hard hire.
It's an easy job, right?
You're definitely seeing firms out there that are, can you say, pushing hard on how sophisticated they are on machine learning and AI, and it's quite limited what they do when you actually get to speak to them and see a little bit under the hood. And we're also definitely hearing from the marketplace, especially from new players, that if we want to go out and raise any capital, we have to say that we are within AI and machine learning. Otherwise, we just can't raise any money. And I think, of course, that kind of is a little bit of a dilemma because and a challenge, because it's kind of like you feel you have to use machine learning or AI to solve certain problems where it might not even be the right attack to it. Yep. And we try internally at RavenPack to say, okay, there are certain things that are better done by actually understanding the sentence structures deeply rather than just throwing some, deep learning type of algorithm at it and then just see what it spits out. So I think sometimes it's other approaches that are the right ones, and we could be forced into doing things just for the marketing aspect. And I think that's something people should seriously, of course, think about.
Thanks. Okay, so we are running out of time, so I think we ought to take questions from the audience in this point. So let's take some questions. Yep. Mike is coming.
Has anyone been able to quantify what the expectations for additional alpha are? So if you're a fundamental hedge fund and you incorporate this, are you expecting 10 basis points? And then what's the ratio of spend to make this happen? And how much should that go to the actual data acquisition to the spend you're doing internally?
That's probably one for me. We have a couple portfolio companies that have studied this issue. So two things. One, an awful lot of people got into stat arb and higher frequency trading and underwrote a big chunk of their fixed cost, data acquisition cost, and infrastructure costs on a stat arb platform that now is finding vaporized returns at the moment. People do tend to lump this in terms of that whole statistical arbitrage, systematic macro, et cetera, infrastructure, because there's a need to construct the infrastructure sensitive to multiple products. But I will say that in our experience, most people do not, quote, add this component, because unless there's someone at the top of the house who really is willing to put capital behind this type of investing, they tend to continue to try to develop whatever event-based or fundamental or asset allocation-based or CTA-driven methodology drove them the first time.
I'm thinking specific to really the fundamental guys that are going fundamental.
Yeah.
Like incorporating cutting hard data.
Oh, I think that
trade,
we see that more on the long-only side, and we do see the typical budget is typically running between hard and soft costs. It's typically running between $1 and $3.5 million a year to add to all research groups all of the sort of sexy information that's needed. We had a portfolio company that was in growth, concentrated growth, and it cost them $2.5 million just to do nothing more than to have all the data sets
Matthew,
in sort of public form.
So some perspective.
I think your estimate is off by orders of magnitude on what it costs to do this if you were a fundamental shop. And I've been working with a few fundamental shops that are fairly large, and the kind of budgets that we've been kind of drawing up and working on are probably more if you're going to do a concerted effort with these data scientists that as Ian aptly says are almost impossible to find, are very hard to find good ones.
I'm not including the human side.
But when you put it all together and you put like the storage costs and the compute costs and the data acquisition costs, you're probably running somewhere into the $12 to $15 million spend, kind of when you're there. And I think, as Yin again really aptly pointed out, the people who have that kind of additional dollars are more of the entrenched players, and when you have that kind of dollars also, you're probably slower moving, that you're not going to be turning over your portfolios every day. And not all of the signals, I mean, Yin and I and others have described signals that are more slowly moving. I think you were also describing some signals that you could use that were more slowly moving by using data analysis. But for the most part, most of these signals are quicker, around a quarter. And if you have in the tens and 20s, 30s, 40s of billions of dollars that you're going to have that extra $12 to $15 million to spend on a data budget, are you really going to be able to capitalize on the information that you're getting? And so I think that it's hard to know where we haven't reached an equilibrium on what the data sets are costing, where the computing costs are, and how you really get the ROI on this. To me, I think that's one of the conundrums that is holding some of this back. But I'd be very interested in Ian if you have a different perspective on this.
No, I agree with you. I think it's just most people, when they think about the cost, they think about there's the data licensing fee. There's actually negligible because the vast majority of the cost is about not only just about buying the data, but also what do you do with it, right? So you have to have people who work on it, productionize it, the supporting it, then the whole production system, maintaining the data storage, and all the storage costs can be very low, depends on how you do it. But the other side of costs is typically order of magnitude higher. I think is what kind of benefit expecting, I think, is survival, right? So in the world of diminishing alpha, I think is keeping our existing alpha is a huge achievement. I don't think there is any more great chance of adding tremendous amount of more alpha. I think keeping it is probably best bet.
In that sense, it's like the move to risk management that occurred 20 years ago. It was more about survival than it was about informing the actual portfolio.
Okay, let's take the last question.
It's really just a follow-on to what you're speaking about. Isn't that the point of the crowd research platforms, is to get over this hump of the big, upfront spend on data analytics and compute cycles?
I guess analytics, yes, but data licenses, if you're going to purchase, let's say, credit card data, you're not going to get them sort of from the crowd. But I think that's a one way to kind of minimize the human cost or analysis cost, but there's no way around data. And then I think like if you're like sort of a big shop, like Matthew was saying, like $30-40 billion, I don't think you're going to rely on sort of like students in India kind of running your models and stuff like that. I think you want to sort of get someone in-house. But anyway, that's my perspective. I don't know if someone wants to.
Well, I actually think that one of the really interesting evolutions that's going to occur in the industry is this bespoke cloud. Whether you look at what FactSet does, or you look at what RavenPack does with the encrypted coexistent cloud, these are designed to reduce that barrier to entry. They are designed to reduce the decisions that have to be made. How do you, before you know anything about data, do you decide which data licenses you need? You have to have experimentation. You have to have a platform for education. And I do see that happening more and more over the next 10 years.
Hey, Marko, just one quick thing. Kind of going back to the theme here, alternative data, why should you care? Do you think both fundamental and quantitative firms should be paying attention to this space? Is it hype or is it real?
Yeah, so some sort of final thoughts from me and from others, if they want, they should be paying attention, both quants and fundamentals. I think big data will produce a signal, now do you use that signal sort of as a discretionary piece of information in addition to other views, or do you productionalize it? That's a sort of a secondary question. Like, first there's the data, and there's some value in the data. So it's relevant equally for quants and fundamentals, I think. In terms of hype or not hype, I don't think it's a hype. Of course, you'll find some interpretation that do sound a little hypey, and people say AI kind of artificially inflated and stuff like that. But it's not. I think we are getting information at a higher speed. We are getting information through different channels, and if you sort of are closed-minded and says, no, I'm going to stick to my traditional quarterly or monthly data sources where everybody else is going to be getting it bi-weekly, weekly, or even daily, I think you're going to lose out. Maybe not right now, but in 3 to 5 years. So I think it's something that people need to kind of move on. The question is, like, obviously speed, and how much you spend and how successful you are. That's another question, but I don't think there's a question the change is happening.
I mean, I think you absolutely have to care. You have to be using this data. You have to be looking for it. You can't be ignoring it. There is no option. It is survival in that way. I think its efficacy, though, at this point is far from proven. And that, again, as I keep saying, as Yin said, the number of firms that we can point to out there who are actually doing this and doing this well and have been successful is extraordinarily small at this point. Whether that changes as more people do it, as we get more talented people in the room, as we get crowdsourcing on this, if that is the answer, I'm not sure it is. As the algorithms develop, as the machines and as we get better and better technology that allows us to do more and more things, as our algorithms develop, the math develops, does that change? Certainly possible. But at this point, I think it is a little bit more hype than it is actual reality of people who are using this in a way to actually generate returns.
I think, again, also like Marko said, I think it's both for quant and non-quant for sure. And of course, the non-quants have the advantage that they are able to put a human overlay to data, which still comes in a fairly noisy format, so they can use various big data or machine learning techniques to kind of prepare the data for them and help them figure out where to focus, and then let's apply that extra overlay to get that edge. If we look at more the quant users, I think you really have to, if you run a quant process, to really start consuming alternative data or big data, because we are seeing that alphas tends to be, they're decaying faster than they used to, so they're not as long-lived. And you'll see that the number of factors that are driving prices are expanding. So it's no longer 5 to 10 factors as it were back in the 50s and 60s, but today we are talking about hundreds, if not 1,000. And of course it's putting a lot of pressure because having that combination, with alphas lasting for shorter, they will also produce less marginal value for each one of them. And if you need to be able to keep on managing the same AUM as you used to, you need to consume ever more data. So you need to think about having efficient processes of bringing data on board and trying to turn it into alpha as cheaply as possible in order to take advantage of it. And I think there is that pressure on the industry, especially on the quant side.
I think the future backend management is really about one of the two things. One, better data, i.e. big data. Two, better way to analyze your information, i.e. machine learning. Is it hype? I absolutely agree with Matthew. I think it's just hype. So people have unrealistic expectations. They think AI machine learning can do everything, but no, as I said, it's in the world of diminishing returns, we'd be lucky just to keep our existing alpha.
And as the fifth person to say this, to answer this question, I would just like to say that given the hour, I'd rather have a drink than an opinion.
Thank you.
Thank you.
This is RavenPack.